Hey, it's Nate Carver, your favorite mortgage guy on Between Two Doors. And our special guest this day, you're going to want to listen to Don Oberle. He is the CEO of CreditIQ.org. And for the over 3 decades, CreditIQ has made its mark nationally. And what's truly remarkable, their expansive presence nationwide is built solely on referrals without a shred of advertisement. Hey, I'm Nate Carver, and welcome to Between Two Doors. They are trailblazers from day one, the very first in the industry, and they proudly wear the title as the all-in-one financial solutions experts. Now, a bit about Don. He's not just a national public speaker. Don is a leading authority on credit, credit scoring, credit repair, lending, bankruptcy law, tax law, and financial fitness coaching, with a core focus within the realm of real estate acquisitions and investments. He's the mastermind behind the creative strategies that have amplified numerous financial portfolios, building wealth through real estate. Since 1990, Don has been at the forefront of educating an impressive 125,000 real estate professionals and over a whopping 650,000 consumers across the nation. His collaboration and training with top real estate agents like Brian Buffini, Barry Habib, Todd Duncan, and Brian Tracy and Real Wealth Network speaks volumes about his caliber. But one of the most telling signs of his success is the overwhelming loyalty to his clients. It's their trust, their personal referrals, and their lifelong relationships he's built. It truly encapsulates the essence of Donald's illustrious career. I too can tell you that I'm a client of Credit IQ. And Don, it is a pleasure to welcome you to Between Two Doors.
Thanks, Nate. Thanks for having me. We're going to learn a lot today, and I'm going to give some tips to your viewers on how to save at least $300 to $600 a month minimum, with some real world practical applications as well. So they'll get a Harvard education today
Wow.
on credit and
Imagine
financial
being able
stuff.
to
So,
liberate $300 to $600 of your monthly income.
mm-hmm.
Wow.
Yep. Yeah, stuff they
I'm
don't teach
all
us in
ears.
school. Well, you've been a good student over the years. We've known each other for many years now. So you do what you say you're going to do and what you commit to with not only your own portfolio, but with your clients too. That's why it was a pleasure doing this with you and your team today. So
Absolutely.
yeah,
Thank
yeah,
you.
you're welcome. So what I want to do is I'm going to show my screen because I'm a visual guy. And so usually most people are visual when they learn things. So I'm going to pop this open here. And let me move my little stuff around here. Sorry about that. Okay, come on, computer. There you go. Let's go back up a little bit. All right. So let's talk about credit scores, and financial fitness. All right. Our team at CreditIQ offers the most trusted credit solutions. And after our podcast today, you're gonna more know what most financial advisors and lenders and planners know about, and what 95% of the population doesn't know. So you're gonna love this. So share this podcast or recording with your friends and family, because right now the economy is a little wonky. I've been doing this for almost 35 years now, and I haven't seen like this before. It's an interesting ride. So, but there's also opportunity as well.
Yeah.
And so what I mean by you and your family building wealth is once you obtain and maintain a 740 to 770 underscore lender score, meaning I'm not talking about Credit Karma, or even if you subscribe to the credit bureau's Experian, what have you, you're looking at what's called a simulated score, which I'll talk more about that in a moment. So So whatever app you're using, you're probably not getting the real score, which we'll talk about in a moment. But so I really want to see if you fall below a 740 lender score, the ones that banks use, like Nate uses and my team uses, that's the danger mark. Okay. And then once you break that, is it 770 kind of, you're kind of the A plus plus paper? Isn't that right, Nate?
Yeah, anything over 770. I get people asking me or telling me they got 820 on their FICO score, and I'm like, that's wonderful. Doesn't do anything. So
Yeah,
that's
exactly.
the magic number is 770, and you'll see
Yes. And that's
everything above that.
traditionally the middle score too, right, Nate? The middle. So you
Yeah,
take the high score, move it, the low score, move it, and use the middle score, right?
that's
So,
right.
so yeah, yeah, okay. So on average, as I mentioned a moment ago, by applying the techniques that Nate and I are going to show you in a moment, you can save at least $300 to $600 a month in interest. And that's if you're making less than 100,000 a year. If your income is greater than 100,000 a year, it's typically 600 to $1,000 or more a month in savings by applying some of these techniques I'm going to show you today. Okay. And that comes with faster approval times and less money down. Because I think in your world for mortgage banking, Nate, because you're one of the top agents in the nation, is it manual under, so you'd rather go do what's called DU, desktop underwriting, than do manual? Is that kind of how it works in your
That's
world?
right. On government loans, I'd rather, if I could write the loan and submit it to Fannie Mae or Freddie Mac up front, I get their
Hmm.
approval on it. That's exactly how I write my loans too.
Hmm.
And
Hmm.
if they say it's up from the front end that it's a good loan, it's a good loan. It'll be a great loan all the way to closing. So that's right.
Right. And if we can hit those 770 plus, then it goes through DU a lot faster, doesn't it?
A
Right.
lot faster, a lot smoother loan. The higher that score, the less they ask for.
Less conditions. Exactly right.
Yes.
Yep. Yep. So with a 740 plus lender score, the real score is, you can then demand, once you go through our coaching, folks, we give you scripts on everything I'm going to describe here because there's a script that goes along with this, so who to talk to, when to do it, and how to do it. So once you break that 740 lender score, you can demand a 0% rate on your next new car loan or lease on a new vehicle, right? But you got to
Yep.
have 740 to do that, to be in that driver's seat, you know, no pun intended. And so, for example, if you go from a 640 score to a 740 lender score, you can, on a $25,000 vehicle, the interest rate alone would save you about $175 a month. A month. If it's a $50,000 car, just double this dollar amount. So we're talking some real savings here by understanding how the game's played. All right. Also, with a 740 real lender score, what the bank uses, you can then talk to your credit card companies and demand them to drop your rates from, let's say, 18% variable or 24% variable, to drop them down to 9.9% fixed, right? And so if you're carrying just small balances, that just that technique alone would save you 85 or bucks a month or more in interest just alone, just that piece, right? If you're
Oh,
carrying
wow.
larger balances, it could be 300 or 400 bucks a month savings. Okay. So, and then did you know that auto insurance uses credit scores, folks? So most people aren't aware of that. So your home insurance and your auto insurance both use your credit score. So once you break 740, we then give you a script on how to talk to your broker and when to do it, on how to demand them to drop the rate and drop the premium once you're at 740. But they're not automatic. None of what I'm describing to you is automatic. You got to know when and how to do it because they're not going to give you that free money. You got to know how to calm the carpet. Does it make sense?
That makes
Okay.
sense.
All right. So, I mean, that alone just could save you 75 to 100 bucks a month right there, you know. And then, but the largest savings for most people in the nation is real estate by applying these techniques. And so if you have a $400 house, you can save 200 to 400 bucks a month by understanding what I just shared with you, right? Or $133,000 in total interest. So, but let me show you an actual calculator. Let me go over here. And now Nate has a much more sophisticated calculator than I'm showing you. This is on our website, but he's got a much better calculator down to the penny that can do it. So if I go to CreditIQ.org, go to calculators, go to mortgage calculator, and I put an estimated savings. So Nate, what would you say the average purchase price you're doing now? Is it like 600,000, 500,000 lately?
Lately, I'd say about 425.
Okay, well, that's very specific. I love it. That's what I love about
Yeah,
you. So
425,000.
I'm going to put in here at four, and so you folks can play around with this calculator too. So I'm going to put 425,000, and I'm going to put in this credit score range. So 850 as high as you can go. So let's just select the 620 for a second. It's a 30-year fixed mortgage. So I'm going to open this up. So now the rates, now Nate can get you a much better rate than what I'm showing you, but this kind of gives
Yes,
you
I
an idea
can.
how it works, right? Yes, you can. I know you
Yeah.
can. The investor pool you've got is bar none the best in the nation. So, but this will give you an idea, folks, of how it works, the game. So let's say you're doing a home loan and you got a 620 score. Then let's say it's 8% interest at 3,100 bucks a month plus property taxes, insurance, compared to getting a 760, 850 score, 760, 770 plus score. It would, let's say 6.5%, it would drop down to 2686 a month plus property tax insurance. So the difference between a score here and eventually getting you up here would save 458 bucks a month, right? $5,500 a year. And by the time we're done, you and Nate just saved $165,000 in interest. That's a lot. That's another investment property somewhere, right? So
Oh my
these are
God.
the techniques on building wealth. Okay. Now, traditionally, what we tell people is when they're in a hurry to, let's say, do a purchase on a property, and let's say they're below 640, then we'll say, hey, once we break 640, and Nate can get you approved, just do it. Don't wait for us to get you all the way up here because what that takes a little bit of time, right? Because you can do what we call marry the home and date the rate,
That's right.
right? So you lock and load, get that payment at 3 grand a month, and then we keep elevating the score. And then once we get you up there, and Nate has, I know you have a pretty sophisticated tickler system that tracks all your clients. So
That's
when you see
correct.
that rate change, you call them, hey, I can get you locked in now, save you 500 bucks a month, right? Let's refi it and drop that rate and drop that payment, right?
That's
So you
right.
can always refi later and get out of it, right?
Yep.
So
And I coach my clients to on their FICO scores for that refi too, since we've got time.
yes,
So we've got time to get there. Yeah.
100%, 100%. So going back here to this slide, Um, let's talk about simulated scores versus the real lender scores. So I know a lot of you are scratching your head right now. What's Don talking about? So the first rule of building wealth through real estate or wealth in period is to know your real lender score. And it says, did you know that Credit Karma and scores you obtain even from the credit bureaus directly as a consumer are fake simulated scores? They're not real, but nobody reads the fine print. Okay. So and also let's say some clients get their score from the credit card company, right? Same thing. So, oops, excuse me. So simulated scores are generally the ones you're used to looking at, you consumers out there. They're generally 20 to 60 points higher than what the real lender scores are, the ones that Nate and banking polls. To make sense? So if
Yeah.
you're on your little app there, if it says you have a 700 score, just subtract 20 to 60 points, and that's probably where your real score is at when the lender pulls it. Okay. It's a good rule of thumb. The easiest way to tell if you're seeing a real score is if you're not paying 50 to 100 bucks for that report, it ain't real. Okay. Because they're very expensive. They charge a lot, right?
Right.
And I think Nate, you pull soft pulls too on occasion when it's appropriate, right? So it
We
won't drop the
do.
credit score. There's no inquiry. Is that right?
Right. We do a
Yep.
soft pull.
Yep. So do we. So as we update you and Nate on the progress, we always do soft pull mortgage reports. That way it won't drop a score, it won't drop, and there was be no inquiry, right? So they're a little bit more expensive doing it that way, but we're more the Rolls Royce of the industry. So Ferrari. So free is never real, right? So if it's free, it ain't real. That's just the simplest way to tell, right? Um, Now, how to achieve and maintain a score above 770. So, um, Here's a grid. Now you're going to see why I said I want to, Nate and I want to see everybody eventually above 770. Is 850 as high as you can go, but once you break 770, it doesn't matter anymore at that point, right? So it's A plus plus. And so if your home loan is what's called a jumbo loan, or let's say it's over 800,000, 822 or roughly to a million plus, then we really eventually want to see you up here in this grade, right? Right, Nate?
That's right.
Okay. So now if the loan amount's below that dollar amount, right, 822,000 or so, then 740 plus is just fine. But if you're below 740, that's the danger mark. And here's why. With the 740, as I mentioned earlier, it comes with better rates and faster approval times for DU. And you can then demand a 0% rate on your next lease or purchase, right? Free up cash flow there, a couple $100 a month. You can then demand the 9.9 fixed rates to drop your credit card interest rates down to 9.9 fixed, right? And then you get cheaper car insurance. So that's the danger mark. Don't ever fall below 740. Okay. All right. Now, if you're a business owner, because I bet about 10% of you folks watching this podcast are small business owners, you really want to be minimum 720 or higher if you want to get a business line of credit. And you want to be in business for 2 years with a minimum 720 or higher lender score, right? To qualify for a $500,000 line of credit or 100,000 and what have you. Okay. Now, if you're refinancing a home and then you're pulling cash out or you're pulling some of the equity out to put in a pool or pay off some debt, the minimum that we like to see is 680 or higher, right?
That's right.
Is that right, Nate? Okay.
That's
Right.
right. Yep.
Yep. And then if you're refinancing your home and you're not pulling cash out, the minimum really is 660 or higher, right? And so, but the higher the score, the better, the lower the payment, the better the rate. But these are the minimums that almost all banks require. That's the minimum just to get your foot in the door. Okay. Is that correct, Nate?
That's right.
All right,
Yep.
perfect. And then, because I know, Nate, you're an ex-military, so thank you for your service. I
You're
appreciate you,
welcome.
brother. I
Worth it.
came from a military background, or my family did. So thank you for service. So I know you handle VA loans too, VA, FHA, conventional investment properties, you name it, you do it, right?
That's right.
Okay.
I've got access to just about everything out there. So
Yeah, yeah, yeah. You're
yeah,
very creative. So, you can go down as low as 580, a VA FHA with low debt to income ratios. I know you probably even got a few lender investors who can go a little bit lower than that, right?
I've
But
got one that'll go all the way to 500, but believe me, it's expensive. I
yeah,
just, it's expensive. I hate to see it.
yes,
So,
yes. And this is why you're hosting the podcast, so that you
that's
can
right.
get this information out there. There's always a plan to get you out of that rut, right?
That's right.
Or there's a plan that if you qualify, you can get a lower payment by, $200-300 a month, right? So usually anything below, 579 or below or is usually hard money, private money with very high rates, like what Nate said, right?
Yeah.
Okay. Do you want to add anything to this slide at all, Nate? Or does that cover it pretty good?
That's covered pretty good. I would say
Okay.
you don't want to get to 500, but it, if you got to have shelter, and you're at a 500 score, you do what you have to do. But I'm not going to leave. I'm not going to leave somebody there. I'm going to get them. I want them to get to where we can get them refinanced. So yeah, this covers the FICO scores.
Perfect. Thank you. Now, this is how banks, employers, and insurance companies assess risk. It says, as a group, consumers in the 700 to 749 range have a delinquency rate of 5%. This means that for every 100 people in this range, approximately 5 will default on a loan, file for bankruptcy, or fall 90 days past due in at least one credit account in the next 2 years. So, CreditIQ and Nate can get you back in the top 1-2% to save you money for a lifetime, right? So if you're looking for a job or you want to get a promotion, most people don't know this is going on. But a lot of employers now, so let's say there's one job position available. Let's say it's a management. You want to get a pay raise and a promotion, and you're wondering,
Right.
like, why can't I get this? Well, this is usually the culprit right here, right? So, for example, let's say there's one position available, and Susie's got a 750 score, and Johnny's got a 620 score. What they're doing is they're looking at the resume and saying, well, let's pull their scores and see who has the higher scores. They're not going to tell you they're doing it, but I know they're doing this stuff, right? So, hey, let's give that promotion and pay raise to Susie because Johnny's got a 31% chance he's going to be late for work, call in sick, or have lack of focus on the job because there's a life event going on,
Wow.
right? So this has been going on for about a decade, and it's becoming more and more prevalent. Um, and if you're looking to move jobs, this is definitely a big stickler for most people, right? So now this is the breakdown of the formula. And by the way, what I'm showing you folks today is part of the 2 to 3 hour coaching we do one-on-one with you and your family. And so you're kind of seeing a snippet, a small snippet of the coaching that we do, that Nate's sponsoring you for. So payment history is 35% of score. Now we all know a late payment can drop a score, but most people have no clue at what degree. So it says any new late payments, collections paid or unpaid, or bad debt charge-offs of any type will drop a score as much as 107 points. Even one new 30-day late payment of $5 can cost you to loan you what the credit score reserve. Now, here's the key point. The lower the minimum payment is that's due that you're late on, the further the score will drop. As it assumes if you can't make a smaller payment, you're in serious jeopardy, and then the score will then dramatically drop. So that's actually how it works. The smaller the payment is, the worse it is on your credit report. A lot of people go, well, geez, it's only one 30-day late payment on my credit card. I'm like, well, that's the worst because your minimum payment was probably $25 or $50. So if you think about it, it makes sense. It's like, hey, if you can't pay this $25, this person is in serious jeopardy. Let's dramatically drop the score. So that's actually how it works. Make sense?
Oh,
So, and also people think, well, hey, I'll just go pay off my collections. Then I'll come to see Nate and get pre-approved on a home loan and life will be good. Well, it doesn't work that way, right?
it doesn't.
So before you start paying off collections and bad debt, let's huddle up with Nate and my team and let's put a strategy together, because what we'd rather do is see if we can remove those unpaid bad debts first, right? Without you paying on them. And if and only if they're going to fight us and they don't want to cooperate, well, then maybe we can do a settlement with them and ask them to delete the trade line on the settlement. So there's a whole technique behind that piece. And then we could get maybe a 100-point jump, right? Rather than 80-point drop by paying them off.
Mm,
Okay. All right. You want to
wow.
add anything to that, Nate? I know you've seen this before where people go,
I've,
hey,
I've
Nate, I
seen
want to
it.
buy a house. I just paid off all my bad debt. You're like, why is your score in the 400s?
Yeah, and it wrecks them. Nobody. It's so counterintuitive, but the credit game, to play it and win, take notes and reach out to us. We'll help you and help you navigate this. This is amazing. I just learned something, and so
Yep.
thank you.
You're welcome, brother. You're welcome. So the next piece is the most important piece I want you and your audience to memorize and apply the rest of your life, and share this with your family because this is really important. So amount of debt is 30% of score. Now we call this the 30% rule. Now this only applies to store credit cards and credit cards, anything revolving debt, right?
Mm.
So what you do is you look at each credit card limit per account, subtract 70% from the credit limit amount. This will equal 30% of available credit. If you're going to use a card, don't ever go above that 30% mark. So let's say you've got $1,000 limit. Don't ever charge over $300. Don't do it. Bad idea, right? That's 30%. So a zero balance on the lender's report when Nate pulls it for the loan, when it shows a zero balance on that report, you gain the most points. Every dollar that shows up in that balance column at the date it was pulled, it takes away points. Once you break 30%, it dramatically drops it. Okay. I mean, we're talking 80 to 100-point swing sometimes, right, Nate?
That's right.
Right. So now, to go a little deeper, creditors report data to the bureaus every 30 to 90 days, which is the key point. Randomly throughout the month, whether it's the 1st, the 15th, or the 30th, when most people carry a balance. They do not report what you paid that month on your statement. So they're not reporting to the bureaus what you paid it down to, but rather what was your balance as a snapshot in time the day they upload their data, thus driving down your score, and they can charge you a higher rate. That's the game, right? So we don't know what day they're going to upload, do we? Right? So, so a key takeaway here is, in a perfect world, ideally pay off all your revolving debt to zero balances 90 days prior to applying for anything, a home loan, car loan, credit card, job promotion, whatever, insurance, right? This will ensure enough time to upload a zero balance and maximize the score. So we train people, I'll show you on the next slide, is that lock all your credit cards away in the safe. That way you're not tempted to use them, wrap up in a rubber band. And then what I want you to do is pay them all off to zero, wait 90 days, don't charge on them at all, and then you apply for whatever you're looking for. That will allow them enough time to upload it to the bureaus because there's a
Right.
lag time. There's always a lag time, right? So, any question on that, Nate?
I would just underscore that lag time, there's not a credit bureau out there or a lender, a credit card company that's going to move their schedule for you at all, ever. So
Yep.
that lag time, and I see that a whole lot when we're trying to get a loan to close. And we're like, if we just wait for this to clear, maybe my scores will go up. It doesn't work that way because we don't know. They don't answer to us. They won't jump through the hoops for us. You pay it off, they're going to send you on their normal schedule a new credit report or credit card report with a zero balance on their schedule, not your schedule or my schedule. And that causes a lot of stress. And so I would be
Yes.
watchful of
Yes.
that 90
Yeah, and
days.
you're very good about like you're a the clients are like getting on our plane and they're sitting down and you're the pilot and you're announcing, okay, we're going to be flying at 30,000 feet altitude and we're going from LA to New York and we're going to have a little turbulence. And that shows you who a true professional is. That's what I love about working with your clients and you tell clients all the nuances that could happen during the process. So that way there's no surprise. And then it's managing our emotional state where I see all these loan officers, they don't tell the clients up front what all the things could happen. So they're prepared for it. And I
Yeah.
found that as long as you tell people good, the bad, and the ugly, what can happen, they're okay with it. When they get surprises, that gets frustrating and it doesn't create a good experience. And so anyway, I just want to point that out for your viewers who don't know you yet, because you're a diamond in the rough when it comes to that, setting expectations correctly. So
Thank you. Yeah.
yep. So length of credit history is 15% of the score. Now, the longer your revolving credit cards, your store cards and credit cards are active and open, the better your score will be. So first off, let me tell you, if you don't have at least 3 active, open, good revolving trade lines that are active, open, and current, greater than 12 months old, it's very hard to get up in the high 700s, if not 800s. Almost impossible. Okay. So for those of you watching this, say, hey, I've only got one card. I'm a joint user or authorized user on my, but those don't count, right? It has to be under just you. Is if you, let's say you have one, you need to get 2 more quickly. And we have some companies we can refer you to that guarantee you get that card, whether it's secured or not. And that way you get the approval going. And you want to age those suckers for at least 12 months, right? So if you think about buying a property or doing a home loan the next 12 months, in the next 12 months, just start doing this quickly. Get those other 2 cards going. Okay. So this is how you manage them. It says, do not ever close a revolving account, store credit card or credit card. Because if you do, this will cause you to lose all the good history you've built on those cards. So don't ever get mad at them and close it. You're going to hurt yourself, right? Instead of closing it, just make a $5 purchase on them, a cup of coffee, once every 5 months to keep them active. Why? Because a zero balance credit card that hasn't been used in 6 or more months, it goes inactive and will then drop your score. So you want to, what I train my clients to do is you go to your calendar and do a reoccurring alarm to alarm you every 5 months for the rest of your life. And when that alarm goes off every 5 months, it says pull the credit cards out and put $5 on each one. Go to the safe, pull them all out of the rubber band. Same day, put five or $10 on each card, put them back in the safe. When the bill comes in the mail, you pay it to zero. Now, if you can do that, it will definitely help your score, right? So they don't go to sleep and because they could close them as well, right? So just to be clear, the definition of an inactive card is any open cards with a zero balance that has been used in 6 months is considered inactive and will drop the score. Charging a small amount on the card every 5 months, this is $5 or less. Paying it off when you get the statement will help the score increase within 90 days. Stealing activity and ensure the creditor doesn't close them from non-activity. And a closed card, once again, if they close it on you or you close it, could drop at 100 points. Gone. Gone. Okay. So this is a pretty big deal. All right. Any
Yeah.
question on that one, Nate?
No, that's
Okay.
yeah,
Yep.
gracious.
Yep.
I'm just
Yep.
thinking about a card that I have not touched in a while. It's got a
Yeah.
on it.
Yeah, and remember to put that alarm on your calendar.
Yep.
Otherwise, I have one, I'll forget, So now new credits 10% of the score. New open accounts drop your score for a year. Once again, always plan 1 year ahead of the curve with any big tickets you do, a car, home, stuff like that. Always plan 1 year ahead of the curve. So don't open up any new accounts 1 year prior to doing a home loan, especially, right? Uh, now, why does it do that? So FICO says, okay, well, if you're going to open up a new home loan, car loan, credit card, whatever, we want you to prove you can handle this new debt for a year. And as long as you weren't late on it, we'll give your points back on the 13th month and then give you a boost on the score. So that's how to properly plan ahead. Now, inquiries, when they pull the credit, can drop it 2 to 3 points. So it says new inquiries, 2 or more inquiries within 90 days can drop it 5 to 22 points. One inquiry within 90 days can drop it an average of 2 to 3 points. So the good news is your points are returned within 90 days of each inquiry. You get your points back after 90 days. The more inquiries you do over a 90-day period, the higher the score loss. Again, please consult with Nate and my team before you do anything. So you're never going to bug us, right? So I was good to just run it by us for, hey, I was thinking about doing this. What do you think? Right? Because I've seen people blow their leg off or step on a landmine by doing silly stuff like that, and you lost the loan over it. Okay. Okay. And then finally, types of credits, 10% of the score. There's a hierarchy as far as credit weighting, the weight of it. Mortgages have the greatest amount of weight with good, bad things happen to them. Then it's auto loans. Now, this is interesting. Do not pay off the car loan in less than 2 years. Otherwise, what will happen? It'll drop your score up to 60 points. Gone. Now, if you're scratching your head going, well, that doesn't make much sense. Well, it's the same reason why it drops your score when you pay off a collection. It's re-aging it. And so FICO can't calculate how much money you've got in the bank. There's no way for it to calculate that. But what it does do is look at patterns. And so what FICO's discovered in their algorithms is when people pay off bad debt or they pay off a car loan earlier than 2 years, what you're typically doing is you're taking your savings or your reserves to pay it off early, right? Which means hypothetically that you may have depleted their savings, and now if if you're sick and you miss a couple paychecks and you have no more savings to fall back on now, well, what's going to happen? You're going to be late on other accounts. So that's why it drops the score. It doesn't raise it. Make sense? Okay. Now, revolving lines of credit, such as bank cards and store cards and other installment loans, now this is a big one, such as student loans, have the least amount of weight when it relates to the balances or the debt load. So I'll give you an example. We've got doctors that were enhancing the credit scores. They're doing a home loan with Nate, and we've seen them pay off $500,000 in student loans in one day. And you would assume the score would skyrocket, right? It only went up 3 points. That's it. $500,000. So the good news for you folks that have student loan debts, you're probably thinking, well, geez, I need to pay off my student loan debt so I raise my score, I can get a home loan. No, it ain't going to help your score, so don't worry about it. That's the good news for you. The student loan balances are not really affecting your scores. But if you're late on it, that's a whole different story. I'm just talking about the balance. Is that helpful?
Yes.
Okay. And generally speaking, what Nate does is he uses a technique where to pay off his student loans rather than work a whole bunch of extra hours is you buy a property, let the values go up 100 grand, 200 grand, whatever. And then when it makes sense to refinance the loan, he's watching it. And then once the rates drop, he'll refi it with you and pull some of that equity out, pay off a student loan debt, and now you're debt free, right? So it's a great technique to pay your kids' student loans off with, your student loans, and get rid of that, right? That
That's
monkey
right.
on your back. Okay. All right. So a mortgage loan carries more positive points after being open for greater than 12 months compared to a type of credit. So we're getting close to the end here, guys. So if you're wondering, well, hey, what if I've got some derogatory credit? Good news is we've got a program for that too. It's called Forensics. So and we cover that in our financial fitness coaching we do with you if you happen to have any boo-boos, right? So within 45 days on our program, typically 40% or more is deleted with a 30 to 50 point jump on the score, right? And I'd say 80% of the time, Nate, all you need is 30, 50 points to get that next tier, right?
That's right.
All right. So now whatever is left on that report that's negative, Then we aggressively attack them again in the bureaus, use a proprietary forensics software program that I developed. My background is aerospace, by the way. So I kind of think like an engineer. That's how I discovered this 3 decades ago. And so we asked them a different set of questions every 90 days thereafter. So this is not the normal credit repair techniques of letter writing, which is slow and less effective. And our work is permanent, it doesn't come back. So this is when all these TikTok people out there are giving you crazy advice, so it's a process of elimination. Eventually we win because we're persistent. Now, within the first year, typically 80% or more comes off with a 100+ point increase, provided there's no more new derogatory items appearing after we start. So as long as you keep your nose clean, you follow my coach's recommendations and Nate's recommendations, this will work for you and your family. Okay. And then here's just a brief overview of all the things that we're involved in, because not everybody needs everything. So the credit and financial fitness coaching is what Nate's going to sponsor you for in just a second. We're going to have a special offer coming up for you and your significant other. It's 2 to 3 hours one-on-one session with us, doing a strategy session, and giving you written advice. And we'll also give you a 5-year written action plan on how to knock down all your goals: investment properties, car loans, business loans, all that. And we map it out for you, right? Most financial advisors don't even do that, right? Because they're too lazy. The forensic credit restoration, if you have any boo-boos, we can talk about that too. We also can assist you with bankruptcy law, so filing bankruptcy if it's really bad, filing your corporate taxes or your personal taxes, dealing with the IRS or the state. So it's a full suite of legal services if you need it. And if you're a business owner, we can do some business coaching with you at no charge, compliments of Nate. Okay, so you might want to thank him for that. And then we also do professional credit monitoring, where you get these updated real mortgage soft pulls, every 6 months for the rest of your life. So you always see what the real scores are at. Debt settlement, we have a team of attorneys that can go in there and usually settle on bad debt for 20, 30 cents on the dollar very quickly. But the most important thing is, I want to show you before we wrap it up, is this. We have a ministry where it's a community and church outreach program that Nate and I can do for your church. So it'd be honored to do a mini version of what we're doing today at your church to help your congregation out with that. Just let Nate or my team know if he wants to come into your church and talk to your pastor about that or what have you. We also do corporate lunch and learn. So if you've got a business and you're a manager and you want your team to get financially fit so they're more focused, we can do this for your company. Or let's say a police union, fire union, whatever organization you want. And then also, if you're a realtor watching this, Nate and I would be honored to come into your company meeting and actually roll this out to your entire organization for your agents, what have you. Okay. And most of the realtors that we've done this with, Nate, they love this. It's really making them cutting edge for their clients, right? We can get a lot of feedback from that. Is that right, Nate?
That's amazing. That's right. That's amazing. I was taking notes and counting and just trying to do really, really fast math. The amount of income that you can liberate just getting your FICO scores up annually is over 10 grand. It's like
100%.
It's closer. I stopped counting at 17,000.
Yep.
And that's just in interest fees, financial fees, all the rates that they charge, that they're going to charge you on your insurance, your other policies. And I used to just think in terms of, we got to get your FICO score up so we can help you buy a house at a lower rate. It's so much more than that. We got to get your FICO scores up so we can liberate your income.
I like the way you put it, liberate. It is liberating. You're right.
Yeah.
Out of bondage and being debt free. Yeah, that's a lot.
Yeah. That's a big deal. What that means into what type of home you could originally afford to what you could now afford, if you wanted to look at it that way, or don't increase that, but just enjoy the fact that you now have given your family a pay raise. Future you will thank you for this.
Yeah.
For getting this fixed. Absolutely. That's why I'm a client. I was looking in terms of, one, getting my insurance lowered on my automobile, and then the next home I buy, I want to be in the top tier on the FICO scores. This is thousands of dollars in savings at closing, and then you're talking a 10,000 plus annually that I'm not having to send to somebody else. I hang on to that, go spend it on my toys or my
Amen.
charities. Yeah.
Amen. Before we wrap it up, I do want to show, because remember I mentioned that we give your viewers and your clients a script on cars, the credit cards, the insurance policies. I'll only show one script so you kind of get a taste, because a lot of people have been, their cars are kind of, in bad shape, and this is a common one. So I'm going to give you guys a treat today and just give you one of the scripts for automobiles, okay, without going through coaching. So this is how you negotiate the deal. So with auto financing, new autos only, a 740 plus lender score gets a 0% rate or tier one financing. Now, tier one is lease terms for 0% interest. So if you wondered what that meant, that's what that means, tier one. Okay. So this is the script you're going to use when you negotiate with your car people. Okay. Now, used vehicles, 1 to 5 years old, 740 plus lender score gets a 1.9 to 2.3 rate. Now, you'll never get 0% on a used vehicle. So that's why we train people, don't buy used ever, buy new. Okay. Because you'll never get 0% rate on a used vehicle. That loan doesn't exist, right? I don't want you paying interest anymore, right? Now, it says, especially do not finance cars over 5 years old, because even with an 800 score, the rate will be too high because it's a high risk loan, right? So now if you're buying a Ferrari, you're going to hold on to it for 30 years. Okay, fine, whatever, right? It's an investment. But other than that, it's your everyday driving car, is either purchase a new or lease a new only, right? Now, do you ever see The Wizard of Oz, Nate, when you're a
Yes,
kid?
I have.
Okay, yeah, I still watch as an adult. So that the guy behind the curtain, the wizard that nobody talks to, right? That's the desk manager, right? So you want to speak with the desk manager only, not the finance manager or salesperson. Why? Because you bypass these two folks and go directly to the desk manager day one, you don't have to pay their commissions, which means now you position yourself to lower the price of the car, which I'll show you next. Okay. So you'll speak to the desk manager over the phone, not in person. Tell the desk manager, I'm above 740 in my score. I want 0% rate or tier one financing. You're going to say this verbatim. Okay. So don't deviate from my script. And then the very best days to buy a vehicle are always the day after Christmas through January 2nd each year. Why? Because it's both the dealership's month and year end. So for the last 20 years, this is a technique I've been using. I always plan it out. Day after Christmas, I'm in there negotiating with the desk manager. Okay. But here's the key. You got to close the deal by January 2nd, or this next piece won't work. Right. So now you know the date and time, who to talk to and what to say. You then tell the desk manager, I want 30% off the price or I'll go elsewhere today. Now, the reason why you're going to tell them 30% off, because I know there's at least 15 to 30% margins in the vehicle, depending on what manufacturer it is. So if you tell them 30, you end up at 20 or 25, great, but don't go below 15% off, because even a terrible negotiator can get at least 15% off doing this technique for sure. Okay. And right now, there's so many cars being repossessed, they can't even keep up with it. The day after Christmas this year, you can definitely get a huge amount off, 20, 25% off, because they're desperate to sell cars right now. If you didn't know that, right? Now, if it was during COVID, no, that they were overcharging, right? But right now, you're in the power position if you didn't know that. So
Oh,
the average savings on a $25,000 vehicle, as I mentioned earlier, just by getting the 0% rate or tier one, is $175 a month savings. Easy, right? By hitting that 740 score, not to mention the percentage off. So hopefully you guys are getting an idea now how our scripts work for each industry, and kind of you got a small taste of our 3-hour coaching of how we customize it per family, right? And so I'll wrap it up with this. So what's your investment if you want some coaching? It's normally $300 I mentioned earlier, but based on our relationship with Nate, you're going to receive that same coaching and report for only $95 as a gift from Nate, right? And that includes your significant other, your boyfriend, your girlfriend, your son, your daughter, your wife, whatever. It's 2 for 1. Okay. Compliments of Nate. You're going to get up to 3 hours of coaching, copy of the lender's report with the real scores. It's a soft pull. It won't drop your scores. And it's not that fake scores you're used to looking at as a consumer. And that comes with a written action plan, how to quickly achieve your goals. It's a 5-year plan, right? And then we'll keep Nate updated every step of the way in the progress, so he knows when you're ready to pull the trigger on the refi or the purchase. Okay. So here's the scan. So if you can scan this in on your phone, this little link here, there'll be a calendar pop up on your screen, and just pick a 5-minute slot for Grace to call you. So you'll get on Grace's calendar, and then you'll tell her when you and your significant others have what day and time is good for you for the full blown coaching, and then she'll book the appointment. So, or you can reach out to Nate, and he can send you through the system, and then have that report ready for us as well. Okay. And then if you got tech savvy, you can also call Grace directly at 925-269-4033, but mention Nate Carver. Otherwise it'll be 300 rather than 95. All right. And so that's all I got for you today, Nate, and your team. You want to add anything else?
I'm going to put the links wherever you're watching this or have found this. There will be links attached to this. So if you're listening on or watching on YouTube, the links will be down below. If you're on my podcast page, it'll be there. If you're listening on Spotify, reach out to me on natecarver.com, and I'll get you just say, hey, I wanted to know more about the Credit IQ, and I'll get you taken care of. And I would love to do some of these presentations with you to some communities. So if you have a church or a civic unit that we could meet with, reach out to me and let me know. This would be a fantastic. I'm just blown away by this. I am so close to being completely clear of all of this stuff and hitting my personal FICO score goal that I was targeting, and I can taste it. And I'm like, I just know I really look at it in terms of liberating. There's some financial goals that I've made commitments to personally, to give to some charities that are very, very dear to me. And I'm going to be able to do that instead of getting a paycheck and you pay your bills, then you're like, you don't have as much left over. And it's a liberating experience to know that your income is a lot stronger than these credit cards make them out to be, than the debt. And so anyway, super grateful for what you're doing, Don, across the country. Thank you very, very much for taking some time out and meeting with me on Between Two Doors. I really appreciated it. Thank you.
You're welcome. It's been an honor. And looking forward to a lifelong relationship with you.
All right. That's it for this one. Thanks everybody for listening, and we will see you on the next Between Two Doors.